This is the first cut by the European Central Bank since September 2019. They are the third major developed market central bank to cut after Switzerland and Canada.
Consumer price inflation has fallen to 2%, bang in line with the Bank of England's target.
Over the quarter, economic data confirmed our expectation of a soft landing, with activity remaining positive and inflation moving in the right direction. And this has allowed a number of major central banks to start cutting rates. We expect the Bank of England to join them in the summer and for the Federal Reserve to start moving in the autumn. Lower interest rates are supportive of equity valuations, particularly as corporate earnings are also coming through at the same time. The narrowness of equity market performance is a source of concern. Technology names are still dominating the returns, but even for the technology sector, the valuations are again supported by earnings.
India's retail inflation continues to ease, hitting a 12-month low of 4.75% in May.
Falling interest rates also make a compelling case for emerging equities. Many emerging economies have brought inflation under control, are running prudent fiscal policy, and also benefit from the global manufacturing recovery that is underway. As we came into the year, there was a lot of concern about elections. And as we said before, politics matter, but they tend to play out over months and years rather than days. In many cases, the results have reflected a rejection of the incumbents. Think about South Africa, India, France, and of course the UK.
Sir Keir Starmer will become Prime Minister with a majority of around 170 seats.
There's been another shocking election result in France, the country's far right suffering a major upset.
And in general, this points to the political consensus being challenged. As we've discussed before, in the last few decades, we had a situation where we had tight fiscal policy and loose monetary policy. And we're now very much in an environment of loose fiscal policy and tighter monetary policy. Of course, the most important election is still ahead of us, with Americans heading to the polls in November. Protectionism is likely to be a key feature of policy, no matter who wins. Immigration policy could be important because it could have an impact on wage growth, particularly against the backdrop of labour markets, which are still quite tight. If we get a Republican clean sweep, we could also see more expansionary fiscal policy. And this could raise concerns about the sustainability of the fiscal deficit and put upward pressure on long-dated government bond yields. This is why we don't view fixed income as the source of diversification that it was in the last decade. However, there's still the good old-fashioned reason for owning fixed income, which is as a source of yield in the portfolio. My teenage son typically accuses me of overthinking, but this year we've kept it simple and it's paid off. A benign growth environment is supportive of equities. Focus on the fundamentals, not on the newspaper headlines.